The security market line is a visual tool investors use to understand the relationship between risk and expected return in the stock market. To understand the line, we first have to look at beta, which measures how much a stock moves compared to the overall market. The market itself has a beta of 1. Anything higher is considered more volatile, while anything lower is generally more stable. The line plots the expected return against beta. It shows the minimum return an investor should demand for taking on a specific level of risk. If an investment sits above the line, it is theoretically undervalued. If it sits below, it might be offering too little return for the risk. This graph illustrates the linear relationship. As beta increases to the right, the required expected return must also increase to compensate the investor. Remember that while this line is useful for analysis, real-world markets are affected by many factors that models cannot always predict. Understanding risk is the first step to becoming a more informed investor. Thanks for watching and subscribe for more finance basics.